You spot the breakout. The candles are surging, the momentum looks unstoppable, and you execute a long position. But the market instantly reverses, your stop-loss triggers, and your position is liquidated. This recent surge across Bitcoin and major altcoins represents a mathematically predictable relief bounce rather than a structural macro reversal. You are getting caught in the multi-timeframe paradox. This is the primary algorithmic trap currently capturing retail liquidity across the market. Here is how the mechanics of this trap operate. An asset can produce a highly aggressive bullish spike on a 4-hour chart, while remaining entirely inside the gravitational pull of a larger bearish weekly trend. The short-term momentum creates the illusion of a trend change, while the macro structure dictates the eventual collapse. To see why, we need to examine the hidden institutional liquidity levels currently plotted on the charts, data points that suggest this relief bounce is approaching a mathematical point of failure. Understanding timeframe dominance is the only way to avoid acting as exit liquidity for institutional market makers. If you want to preserve your capital, you have to look at the market through their lens. We have to step away from the crypto charts to find the true catalyst for this current market structure. The engine driving this movement is actually the S&P 500 4-hour chart. This S&P 500 chart shows a sharp drop, while the RSI momentum oscillator below dips past the extreme oversold threshold. Hitting this rare extreme, unseen since late 2023, automatically triggers algorithmic mean reversion buying, forcing a localized upward correction. Because crypto currently operates as a highly correlated asset class, this algorithmic equity bounce maps directly to the simultaneous short-term upward price action we are seeing in Bitcoin. But when we contrast this 4-hour micro bounce against Bitcoin's weekly chart, a stark reality emerges. The asset is still laboring under a massive, unresolved bearish divergence that looms over the entire macro structure. A bearish divergence occurs when the price of an asset records higher highs, but a momentum indicator like the RSI records lower highs. This signals a structural weakness that eventually overpowers short-term momentum spikes. Bitcoin and altcoins are currently trading as derivatives of automated equity algorithms, rather than demonstrating independent fundamental strength. This makes the current rally incredibly fragile. The 4-hour bounce in Bitcoin traces back to a specific mechanical event, the liquidity sweep. This heat map shows localized retail stop losses. The bullish divergence functioned only after wiping out the dense cluster between 68,000 and 68,700. With that fuel consumed, the market is depleted, leaving only 3 isolated pockets of weak interest. These weak new pools are forming at the 67,200 level, the 72,000 mark, and up at 76,000. Because the liquidity serving as market fuel is thin, the price action will likely compress. We should expect a slow grind upward directly into major overhead resistance between 71,000 and 72,000, rather than a clean, vertical breakout. Directional momentum is dictated by where retail stop losses accumulate. Since the heavy clusters are gone, the current bounce is artificially engineered and running out of fuel. Operating manually in a low-liquidity, choppy market environment dominated by algorithms is exceptionally difficult. Profiting here requires a rigid adherence to range trading. This means shorting resistance and longing support, a strategy that demands flawless execution speed to avoid slippage. Slippage is the difference between the expected price of a trade and the price at which the trade is actually executed. To match institutional execution speed, you have to upgrade your infrastructure. This is why we integrate with BingX for our trading setups. In conditions where you need to front-run algorithmic fakeouts, BingX provides low-latency order execution. When the margin for error is measured in fractions of a cent, milliseconds matter. You can access specialized sign-up bonuses and direct one-on-one trading communication channels exclusively through the link in the video description below. In a market designed to hunt retail stop losses, upgrading your execution infrastructure is your primary defensive mechanism. We can apply this exact analytical framework to high-cap altcoins, starting with the Ethereum 3-day and 4-hour structures. Ethereum's recent price action is a correlated echo of Bitcoin's bullish divergence. It was triggered by the same near-oversold conditions on the 4-hour RSI. A structural block of overhead resistance is waiting to meet Ethereum's relief wave, sitting squarely between 2,200 and 2,400. Shifting focus to XRP, we see a similar pattern. Its recent volatility is tethered to Bitcoin's short-term liquidity sweep, rather than independent network news or adoption. XRP did manage a mechanical breakout above its immediate descending resistance line. We are tracking the flip of the $1.42 level from prior resistance into a new level of micro support. However, there is an immediate upside resistance grid, specifically isolating the $1.45 to $1.47 zone. The rule here is consistent. These altcoin moves are correlated echoes of the macro equity bounce. If Bitcoin hits its overhead resistance and rejects, these altcoin structures will likely fail alongside it. Solana's current market structure illustrates this clearly. We see a micro breakout taking place entirely within the confines of a multi-month bearish trend. Solana's recent push above the $88.70 short-term resistance level is driven by 3-day oversold relief mechanics. The high-probability rejection zone for Solana is resting dead ahead. There is thick resistance sitting right between $95 and $105. Chainlink's current price action is best described as pure, choppy sideways consolidation. There is no directional trend present here. The boundaries of Chainlink's current trap consist of strong algorithmic support between $7.90 and $8.50, and overhead resistance from $9.50 to $10. Surviving this altcoin environment requires aggressively trading the range boundaries and taking profits early. Holding for a macro trend continuation often results in portfolio depletion. The data demonstrates a consistent relationship between timeframes. A 4-hour mean reversion wave rarely negates a weekly structural downtrend. We are currently floating in a temporary liquidity vacuum, buoyed by weak momentum. Over the next 24 to 48 hours, expect a slow grind into major resistance structures, where the momentum will likely grind to a halt. The exact quantitative danger zone for Bitcoin is the resistance block resting specifically at 71,000 to 72,000. Entering long positions inside these overhead resistance boxes provides the exact liquidity market makers need to fill their short orders. The critical missing piece of your defensive strategy is knowing how to identify the hidden order block footprints that suggest a rejection is underway at these levels. To learn how to track these whale order blocks and finalize your defensive trading strategy, click the video on your screen right now. I will see you there.